every time I speak about this topic, I speak passionately about it, right? Because I feel like a lot of people don't know or don't understand, fully comprehend the actual the size of this, right? And I get asked the question a lot, and people make statements to me like they're the experts and all that sort of stuff. And really, what it comes down to is people asking me, why should I care about it? It's a mortgage, I have to pay it anyway. And really, is it really going to make that much of a difference? So we've got a calculator. We're going to put that into somewhere around this video, maybe in the description, so that everyone can play around with it in their own circumstances. And we're gonna, if you're listening to this, awesome. But if you're seeing this, we'll overlay some video and images and text here, so you can sort of play along at home. But all I've done here in this calculator is we've just got the mortgage amount, the term, the interest rate, and what that might be as a comparison to say if we reduced it, what it would turn out to be. So the average mortgage in Australia is $730,000 across the whole country. That's, if like we're in Sydney, if you're looking at that, that's easily $1 million. But let's use $730,000 as the average mortgage amount. And then the current term remaining, or the loan term, let's put in as 30 years. What are you seeing in your experience in broking and all of that sort of stuff? Most people opting for a 30-year loan, is it 20, 25?
Yeah, I guess the default by the bank, and every bank that you kind of do a mortgage with, is the default years is 30 years. Most people that do get a mortgage have no idea what the default even is or what that loan term really means. But yeah, 30 years is usually.
So why do they do that?
Well, it kind of gives the bank the opportunity to be able to actually lend to the customer, because they have to be within guidelines of, affordability of that loan. Technically, they can afford a loan over 30 years because the repayments are lower.
Yeah.
But interest-wise, it will kill them.
Yeah.
In the long
Okay.
term.
Yeah. Cool. So let's just plug around with current interest rate. I'm just putting in 6.5%. That's not what the current interest rate is now, but you can put any amount in there that you're currently paying. In this example, let's just say we got the loan term down from 30 years to 15 years. So we just halved it. So we're not doing anything ridiculously crazy. We're just halving the loan term. And let's just say we were successful in negotiating a lower interest rate. So from 6.5% down to 5.8%. So what that means over the loan term is that by cutting off 15 years on the mortgage, not only are you free 15 years earlier, right? But you save $566,000 in interest. You still pay $364,000 in interest. So don't worry, the bank's still going to make their money. That's totally fine. But you're actually saving a huge amount of that, and obviously cutting the loan off. So a $730,000 mortgage is going to cost you in minimum repayments for $4,600 a month, so $4,600. And now you've got the ability to use that $4,600 a month on whatever you want. So if we look at that situation, what's the first thing that comes to mind to you when you see those numbers of saving $500,000, getting out of debt 15 years sooner, and paying the bank far less in interest?
Yeah, I mean, it's a crazy stat when you kind of break it down into kind of finer details like that. I want to encourage everyone listening to this that every time you buy a home and you get a mortgage with the bank, you're basically essentially, I guess, doubling the home's value to the bank itself. So if you're buying a $1 million home, you're basically paying back $2 million if you stick to that minimum repayment over 30 years. So, if somebody told you that before actually buying the house, I think there'll be very much less homeowners in Australia.
That's crazy when you think about it. So effectively, you borrow $1 million with interest, you end up paying back $2 million. Yes, okay, the property is going to go up in value, right, over that period of time. But that's if you stick to the 30-year term and you don't refinance every 3, 4 or 5 years and reset the mortgage to 30 years. We'll talk about that later and in different episodes as well. To me, when I see this and I see the opportunity to cut down how much money I'm paying to the bank, basically as a tip of $500,000, I think if that money was in my pocket, what would I do with it?
Exactly.
And so, $4,600 a month, you can just let your mind run away and fantasize about what you would spend that $4,600 on. If you had an extra almost $5,000 a month, what would you spend it on?
I'll be going crazy. I'll be
Yeah.
going,
Go on. Like what? Like what?
I'll be buying new shoes every single month. I'll be going to golf way more often than I, definitely should be.
Yeah.
I'll be doing so many more.
Probably
things.
working less as well.
Yeah.
Oh no, well, not here.
Not
like
here.
stay here. Like for me, I love traveling with my family. We love going on cruises. I've got a cruise coming up at the moment.
You can go on a cruise every month with them.
I would just live on a cruise ship, honestly.
half the month.
Honestly, and I know it's not everyone's jam, but when the grandmas come up to you and want to talk to you about how the drink is and where you got it and all of that sort of stuff, I just can't think of anything better to spend money on. And at almost $5,000 a month, there's I could go on a cruise a month basically. Yeah. That's what I'd be doing.
Yeah,
with
I mean,
that.
Even if I look at it in a different light, where the average Australian will actually only own one home in their life if they do own a mortgage, and that mortgage will usually end around their retirement age. So if you had an extra $500,000 at retirement, that can go such a long way rather than giving that extra $500,000 to the bank. If you had the extra $500,000 plus your super plus whatever savings you had on top of that, that $500,000 will stretch so many more years. Your quality of life goes up way more with that extra cash instead of paying it to the bank.
The worst part about this stat, I think, and these numbers are, number one, it's just maths, right? So there's no crazy tricks or whatever. Basically what you're doing is you're making additional repayments at the rate that you can that's going to get you from 30 years to 15 years. Now, how you do that while still having a lifestyle and not living off beans and rice all the time, that's that's something that we cover in other episodes. But really, at the end of the day, it's just keeping the money for yourself instead of giving it to the bank. And this is how these mortgages have been structured. They've been structured in a way that the repayments are as low as possible so they can lend you the maximum amount over the longest period of time. And that is what's the most profitable for the banks. So in these scenarios, let's just play around with some other numbers, right? We were talking about Sydney before. All we'll keep the loan term at 30 years, current interest rate at 6.5%, reduce the loan to 15 years at 5.8%. But let's assume that it's $1 million that we've got in a mortgage. So normally, with a normal mortgage, you would pay back $2.2 million on that. So more than double. So you're basically buying the bank a house as a thank you, right? If you paid off more and did that faster over 15 years, you'd save $775K in interest, which means not only are you debt-free sooner, but that $6,000 a month, which is the minimum repayments on $1 million mortgage, all of that then goes in your pocket. So basically, I suppose the point that I'm trying to get across is the higher the mortgage that you've got, the more opportunity there is to save. And the great thing about this calculator, as I said, we'll put a link somewhere around here in the description, is that you can play around with this all that you want. 15 years is just a number that we plucked out of the air. Let's take that $1 million and have it at 10 years instead. Will you save $1 million, $955,000 in interest?
Exactly.
If you can only do it in 20, because that's all that you can do, still $500,000, $583,000. Huge numbers.